Hi, everybody. This is Jeff Barton. Thanks very much for tuning in, for watching what we're doing. This is the Mortgage Minute. We try to come to you a little bit on Facebook, a little bit on LinkedIn, some Instagram, and certainly Twitter. We talk about the mortgage industry and how what's happening today can affect the rates. Basically, that's why the rates go up and down a lot is due to either what's happening with the 10-year, what's happening with the economy, or what's happening right now with inflation and also the debt ceiling and a bunch of other outside of actually the norm events that occur in Washington that seems to spook investors, and people then do things with their money. For instance, the 10-year Treasury today is up at about 1.5%. Haven't seen those numbers for quite some time. We've been flirting really in the low 130 range, 1.3 percentage range. Once it gets going up into the 1.5, that means that people are nervous and do not want to buy U.S. debt. Why? Because it looks like the U.S. may default on the debt for the first time ever. And whatever the political leanings are in your particular mind or what's happening in Washington, that affects you because interest rates are also going to go up. We've seen actually interest rates dip a little bit today, but we have been seeing a trend over the last 2 weeks of the interest rates going up. And that will continue as we get further into the year. If we see interest rates go up, we're obviously going to see a cooling in the real estate market, which is a good thing because we might finally see a drop in prices. We've been seeing a 2-year run in prices, which has really priced people out of the market. And with rising interest rates, that's probably going to mean you too. So hoping that we get those, not only the rates go down, but certainly to be able to say, hey, look, prices need to come down. Yes, it is a supply and demand issue, but currently, right now, we're not going to get more supply. So really, the demand has to lessen, and that means fear in the U.S. debt. People get scared. They get scared about inflation. They get scared about paying for groceries. They get scared about a lot of things. It's part and parcel to wanting people to get back to work. In my opinion, it's somewhat of a manipulated thing. Whether it's a Republican or a Democratic idea in Congress, getting people back to work is the number one priority for most people in government. Why? Because your taxes pay for all the things that are on either wish list, whether it be the Republican and Democrat. And for me, I would like to see obviously rates stabilize, remain where they are, but they're not going to. And as a result of that, we're going to see less loans. And so the layoffs in that particular industry, the mortgage industry, the real estate industry, are inevitable. Whether they're now or in 6 months or a year, they're coming. And so we will see a lot of different people in the mortgage industry fall out. This show is sponsored by Malibu Funding. Malibu Funding is a 20-year-old company, a couple hundred people that work there, and about half dozen to a dozen states, and they are and probably will be one of the companies that remains. But if you have interest in doing refis or mortgages or anything like that, you just give them a call at 1-800, or it's right on the screen there for you, 888-713-2929. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much. This has been the Mortgage Minute.